Top three things this morning: number one, China; number two, the 10-year bond yield again in the U.S.; number three, that British pound that continues to go higher. So the first thing on China, and basically because I have nothing else in Asia to talk about because most of Asia was closed, but China, just as a friendly reminder, had a horrendous year. Why? Because growth slowed in Japan. So again, if you get the slope of growth right in our model, you tend to get asset allocations and investments in equities versus bonds, for instance, right. And again, the point is that China slowed. Now, the question in 2014 will China continue to slow? The answer is not clear to us, so we don't have a specific call on that yet. But for now, just remember, China was down 3.9% for the year to date, with the S&P 500 up 29% for the year to date. Point number two, on the 10-year bond yield, is sitting right at its year-to-date high. Now, there was a collective wisdom on Old Wall Street that, of course, if interest rates went up, the end of the stock market would occur. And, you know, tapering would spell the end of the stock market. Well, not so much. Didn't happen in September and didn't happen in December. So again, what you see unequivocally here is the combination of rates rising equal bonds falling, gold collapsing, and equities continuing to hit year-to-date highs. So again, this is a growth investors market, or has been, and will continue to be, provided that bond yields go up. So again, watch that fund flow story as we enter the new year. Finally, the British pound continues to be our favorite currency in global macro. That's hitting $1.65 versus the dollar this morning. Fresh new highs, and again, the economic data supports it, as does the monetary policy. So backing off quantitative easing in the UK alongside accelerating economic growth. Again, slope of the line, Hedgeye playbook was the call there. So we hope you stayed with that. And those are your top three things.